Hello, welcome to Libron Module 4. And today we're talking about bank mergers and antitrust issues. There is a huge trend in the banking industry toward mergers, and we're ending up with fewer and fewer institutions and larger institutions. And you may wonder why that is happening. Some of it I do think is the law. It's kind of pushing them toward that. And some of it is the world, the way the world is more interconnected. Having larger banks is beneficial for business transactions, for customers, and for the banks themselves. But it's really business and financial reasons that predominantly are what drive these mergers and these acquisitions. As our reading talks about, there's a variety of efforts that go into this. Any type of a merger or an acquisition is a huge effort on the part of many bank employees, as well as many outside people, accountants and lawyers, and just a whole host of individuals. And there are many things that have to be kind of hashed out. And as your reading talked about, it's the pricing, how it will be priced, how it will be paid for. And once that is done, a letter of intent is drafted between the parties. That would involve, of course, lawyers. And then you get down to the due diligence. And that's going to involve the compliance professionals, as well as the lawyers, to review each other's sort of documentations and processes and procedures, and the level of compliance. And so one of the big pieces that precedes any kind of a merger or an acquisition is really understanding the compliance posture of the entity being acquired, because the acquirer really wants to know if they're kind of stepping into a lot of potential lawsuits. So the due diligence is really focused on compliance, and compliance professionals will definitely be pulled into that. There's also a lot of, I think your book refers to it maybe as political issues. What is the name going to be? Who has the better name recognition, the better name reputation? Will you continue to offer all the same products? Will the products be merged? Will they change? How will you convey that to the customers? As you can imagine, all of this really involves a lot of compliance input, because any kind of changes in products typically will require notice, and all of that requires knowledge of the legal requirements. And then there's also the idea of who stays on board and who goes. So it can be a busy but a scary time. Once you get through all of that and sort of the deal is pretty well set out, there are then a number of approvals, both from the bank executives themselves, the shareholders, and ultimately the regulators. And since this is rather a regulatory compliance class, we're going to really focus on the regulator approval side. And so as your bank sets out, there are 3 different laws. They're all quite similar, but they apply in different situations. If it's 2 banks, 2 FDIC insured institutions combining, it's the Bank Merger Act. If it's a bank holding company situation where there's a parent company that's merging or acquiring a bank or another bank holding company, depending on the size of this transaction, it's the Bank Holding Company Act. So that is going to be the larger, more sophisticated mergers and acquisitions. And then at the other end is the Bank Change and Control. This deals with the smaller acquisitions, say a family-owned bank being acquired by an individual, and consequently a little bit simpler. When you're under the Bank Merger Act, you first have to determine what is going to be the ultimate type of institution. At the end of the day, are we going to have a national bank, a state bank that's a member of the Federal Reserve System, or a state bank that's a non-member? Because that will determine the regulatory agency that needs to give the prior approval. And something to always remember is anytime you see the word prior approval, that means time, that means money. So a lot of work has to go into this process, and then the regulator has to give it its stamp of approval before it can move forward. As I mentioned, if it's a situation with a larger institution with a holding company, either one or both of the banks, it will be the Bank Holding Company Act. And really, this brings in the Federal Reserve Board. Anytime you have a company that's acquiring another bank holding company or its first bank, even if a regular company acquires its first bank, that company is still under the bank holding company approval process with the Federal Reserve Board. And it's a pretty low threshold for what will trigger this. It's really just 5% of the voting share. So anytime a company has really any type of interest in a bank, it almost always is going to trigger the Bank Holding Company Act. And that relates to a question that we had in our reading that implicates how it's difficult for some companies or individuals to invest in a bank because they immediately can become subject to this regulatory scrutiny. At the other end is the bank change in control, which really deals with the very small sort of individual family owned. And you'll notice, quite important, it's only 60 days prior notice with the ability for the regulator to put a halt to the transaction. And it's sort of a no news is good news situation. But this only applies if it's a personal situation. So a person, it can be an individual or a family partnership or a trust. And control in this situation is 25% or more. So it's a little bit more lenient. Regardless of which of the laws you're under, it's a fairly similar process. One is there's going to be a public comment period. So this is a public process to some extent. Obviously, a lot of the financial information is all protected, but the existence of the request and the seeking of approval is public, and anyone in the public is permitted to comment positively or negatively. And the other regulators are all informed of the transaction. So as I mentioned, the regulatory body will be the OCC or the FDIC or the state, depending on, what is the final institution going to be, but all the agencies will be informed and able to comment as well. And what the regulators are going to be looking at and deciding whether to approve or not are the items listed here. And one is the competitive factors. This is the idea of antitrust. Is this going to be good or bad, really, for the public in an antitrust sense? The next, which is somewhat unique here in banking, is the idea of the banking and community need. And we'll also be talking about the chartering process, and we see this again in that process, because the regulators are wanting to see, is there a need for another bank in this community? And this is not to be looking at whether the bank is going to get enough business for the benefit of the bank itself. It's whether the bank will get enough business for the benefit of the community and the banking system as a whole. And another interesting part of this process is a very deep dive on the management. Who is going to be in charge of this institution? Are they knowledgeable? Are they sophisticated? Do they have a good track record? And certainly, do they have no legal or regulatory blemishes in their past? It's very important to have upstanding, respected, knowledgeable leadership. And of course, the money. Is there enough money there? Can this deal go through? Can you show if someone is acquiring another bank, do they have the resources to really make this work? And so what we saw in our reading is that this process is similar to any type of an antitrust process, any type of an antitrust review that could happen in any industry, as far as the fact that the board cannot approve any type of merger or acquisition that would result in a monopoly, or which would kind of further a conspiracy to monopolize an area. And they're also not to approve any kind of a combination which could substantially lessen competition or tend to create a monopoly. So these items under B are a bit more gray. And most importantly, they have this unless clause, which we don't typically see in general antitrust law. And that is, unless this lessening of competition is outweighed by the public interest in meeting the convenience and needs of the community. And this is often used if, let's say, we have a very weak or a failing bank in a small community, and a very large, powerful bank wants to acquire it. One could easily say this is substantially lessening competition or it is moving toward a monopoly, but it's so important for this bank that is in a community maybe that's underserved not to go under, that the regulator will approve this type of a transaction, and they legally are permitted to under this unless clause. And so these are the types of factors that the lawyers and the compliance professionals need to be thinking about, because when this application is made, it's not just kind of submitted to the regulators to draw their own conclusions. The bank itself will feed the information to the agency in a way that reaches the desired outcome using basically the law as their guide. And so when we see this being done by the regulators, this is all right out of the statute. They are required to look at the managerial resources. They're required to look at the competence, the experience, and the integrity of the officers, directors, and principal shareholders. So if you would want to take a look at any of these, and they are public, you will see a work history and resumes of the officers, directors, and principal shareholders. There will also be financial information on these individuals, but that will be redacted and not open to the public. A lot of our reading for today dealt with some cases that really established how these antitrust reviews would work in the banking context, because antitrust is, of course, an area that goes throughout the US economy and the combination of large institutions in all areas. But banking has a bit of a different path, and the cases we read really point that out. And the two big issues are the line of commerce and the geographic market. Those are the two issues that had to kind of be resolved in the banking context. And so this United States versus Philadelphia National Bank from the 1960s was the first really big case to kind of test how this would work. And it was an action to stop a merger of two large Philadelphia banks. And the key part of this case, and the reason that we read it, is this footnote about the line of commerce. Because at this point, it really wasn't clear whether we would say that banks compete with lenders, since others make loans that aren't banks, and whether banks, when they're doing their antitrust review, would consider all the other players in the economy. And this case determined that no, banks really only compete with banks because they offer what is now referred to as a cluster of products that no other institutions can offer. And so in a bank antitrust review, you're really looking at only other banks, and that is the antitrust review, that is the competition. Now, one could argue that over time, this is not accurate or correct, but it's currently still the way the antitrust review works. And how it goes is that the regulators will look at, in this case, is this bank, one is the second largest, one is the 21st largest. It's the second largest in Philadelphia, rather, and the 21st in the nation. And the other is the third in Philadelphia. So it makes it really, honestly, quite more manageable. And then they look at the resulting institution. And at this point, they looked at assets, deposit, and loans, although today the real focus tends to be on the deposits. And they look at the resulting bank, both in Philadelphia, where it became sort of roughly having a third of assets, deposits, and loans, a little bit more of deposits, less of loans. But it then also looked, if you look at this new bank as well as the next bank, and this is where we really see probably the concerning numbers, where it's really up close to 60%. And so when they looked at these numbers, it was somewhat easy to determine that the firm would control an undue percentage of the relevant market and result in a significant increase in the concentration of firms in that market. Now, to this day, there is still no black letter number or percentage that is an undue percentage. So it's still a bit of a gray area with an undue share without any specific number that you must avoid. However, after this case, this is when the law changed to the law that I just talked about and that we have today. At the time of that review, the Philadelphia case, there was not this unless language. This unless language was added after that case because it was decided that banks are not exactly like other businesses, and the public interest could outweigh any anti-competitive effects. And so this is the law that we have in place today. We did read a second case that dealt with a challenge to a denial of a multi-holding company. And in this case here, this was in Missouri and St. Louis. And so when you looked at these numbers, they don't look anything like what we saw in Philadelphia. We have the 10th largest and the 13th largest, and we have, 1.6% of deposits and 3.2% of deposits. So these are far less alarming numbers. But nonetheless, in this case, the Federal Reserve Board did deny this merger. And basically what they said was that there was a harmful concentration. And so the parties challenged this on the basis that they did not use the statutory language. They did not find that it was substantially lessening concentration or that there was a monopoly. They merely found a harmful concentration. And the court ultimately said that that is not up to, the Federal Reserve Board, that it is not a harmful concentration that can result in a denial. And so the case that we read really establishes that when the regulator is determining whether or not to approve something, if it's a denial, it has to, if it's a monopoly, it's a denial, no questions asked. But if it substantially lessens competition or maybe a restraint of trade, it may be a denial unless the anti-competitive effects are outweighed by the public interest. So there is a way to counteract a potential anti-competitive and lessening of competition. And as I said, this is really used quite often. And in fact, what we see is that almost all mergers and acquisitions are ultimately approved, unless we have, bad actors or some kind of bad behavior. But oftentimes it is a process, and there are mitigations that are offered up to get sort of to a place where the regulator's comfortable. And some of the mitigating factors are, for example, let's say a bank is acquiring a bank in an area that's rapidly growing. So there's a lot of potential competition that would favor approving a merger. How strong the firm being acquired is. If it's weak, the bank regulators are always happy to see a stronger firm acquire a weaker firm. What are the economic conditions in the market? Is it unstable, stable? What will make the market seem more competitive, but also more stable? And is there competition from other types of institutions that aren't banks, so that we need to maybe look a little broader? And that's happening more and more now. And they also look at whether there are other strong firms, even if the firm being acquired will create a pretty large institution if there are other strong firms that will favor allowing this combination. And another item that we see often is some divestiture, getting rid of branches or getting rid of certain parts of the business. So usually through the process of sort of discussion and compromise, we see almost all mergers and acquisitions these days going through. Some don't like that, others think that's fine. And I think that was another one of the questions and, in the reading, is it a good thing that we are finding ourselves in a situation with far fewer institutions, but by and large, they are strong and well capitalized, or would we be better off with many more institutions of smaller sizes that may not be quite as strong financially? That's certainly a question that doesn't have any easy answer and doesn't have a consensus of views. So that's the end of our discussion on bank mergers and antitrust. And feel free to reach out if you have questions. Thank you.